guys, how are you? Andy Superfounder and CEO Y2K Credit Solutions. We're back in the drawing room at class. Got the whiteboard out, so you know some gems is about to come, about to break some stuff down. I actually started writing it down for you guys. But anyway, let's get into this topic. Let me tell you how this topic came about. Yesterday, a realtor called me and said, "Hey Andy, do you have a connection or access to hard money?" I said, "Hard money and a hard money loan for a home?" "Yes." "Well, of course we do. We have our own in-house bank that we could fund our clients' mortgage anywhere in the US. Obviously, we have access to hard money. We have our own real estate brokerage, so obviously we can service anyone's transaction, buying or selling." So I was like, "Why do you need hard money? What's the reason?" I have a client that has 3 condos. One they're going to be selling. All 3 of them have very small mortgages on it, but they want to buy a house and they don't have the capital for the down payment. So they wanted to get a hard money loan, and they wanted to put up one of the condos as collateral. And they only want it for like 3-4 months. I guess they're gonna put the condo up for sale. It's gonna sell relatively fast. They'll have the money to pay the hard money off, the loan off. So I'm like, why would you do that? I'm like, what's the reasoning for that? But then I realized he was asking directly, he's really asking me if I would put the money up for 3 to 4 months and charge a certain amount of interest. I was like, how much interest do you think they charge on these hard money? He's like 6, 7. I'm like, no, double that. He was flabbergasted when I told him that. So the reason why I'm doing this video, one is to break your options down as a buyer or seller, but also, listen, there's a lot of realtors out here. I don't have a problem with any of them, but a lot of realtors don't apply themselves and apply the knowledge that they learn. I understand if your real estate is the only source of income, obviously the market is tough right now, so you'll do anything to get a sale. So you'll put some clients in some kind of deal that may not actually work with them financially. So my message to you as a buyer or a seller, or even a realtor, educate yourself on what you're doing. All this information on social media, not social media, the internet. There is realtors' website that have this kind of data, mortgage websites that have this kind of data. Educate yourself so you understand what you're doing. Don't wait or don't depend on someone else to give you information. This stuff is relative, and you'll be surprised how much you know more than what the realtor knows. Anyway, let's get into this topic. Hard money. This is hard money, right? Hard money loan is at a 6 to 12 months. The investor wants you to hold it for 6 to 12 months. Okay? Interest rate in our bank, the interest rate is 11%, but it goes up to 12.5% on hard money interest only for the year. You're paying that for the whole year, right? You have to have 20% skin in the game. It means you have to have 20% down payment. Why would you want to put hard money? Why would you want to do hard money at these terms? Now, this is just if you're buying a new property. What this realtor was asking for does not fit this client's need. You're actually just putting this client in debt, a lot of debt that they don't need to be in. Now, we have the mortgage, traditional mortgage, right? 6.75 interest rate currently as of today, as this video is being shot. That's the rate, and this is contingent to your credit score. This is not buying a home. So they're already buying a home, but not yet, right? So that would be the mortgage. You have a HELOC, home equity line of credit. HELOC, you have to get a 720 credit score, and you can get anywhere from a 6.75 to 7% rate up to 30 years, okay? If you have a credit score below 715, it's 8 to 9.75% up to 30 years, HELOC. Now, a HELOC is where this person wanted to be, where he should be putting his client. Let me tell you why. 1, they have a condo. 2, they have equity. 3, they only need it for 4 to 5 months. 4, based off their credit score, their rates will be anywhere from the 6.75 to 7. This is the option that he wanted to put the client in. But clearly the realtor still didn't understand what I was telling him. Then you also have a home equity loan. This is a new product. Our bank offers it. It's a second mortgage essentially. For example, and also it's a blended rate. That's a blended rate. So let's say you have a mortgage on a home and you have 5% interest. You have $400,000 worth of equity, $400,000 worth of equity. We'll give you a loan for a second mortgage for $200,000, Obviously, the rate will be a little higher. I think the rate was, sorry, let me confuse it. The rate was 10 to 13%. And you get this at closing, right? However, because you have two mortgages, it'll be a blended rate. This is a little confusing product. I don't recommend you using this unless you're actually skilled in what you're doing. But a HELOC is where you would want to go to get money out of a property if you wanted to buy a new home or use it as a down payment and you only need it for under 6 months. With affordable rates, the credit scores have to be good, and a HELOC is like a checkbook. Write as much as you want, you pay back what you use, right? If you don't use the whole thing, you put it back, right? And most banks will give you 85% of the equity. Here's what I want to talk to you about though. Not every bank does HELOCs. Currently, credit unions and TD Bank are the only two banks offering HELOC that I know of that are really good terms on the market. And also we have a partnership with TD Bank. So obviously we'll tell you about their products because we know their products like the back of our hands. But ideally, hard money is not where you want to be at. You need to really understand what hard money is. This is putting the client in debt. It's not where the client needs to be. I don't know why they would recommend this to the client. This is not an option. And also, even if you find a person like myself that's an investor that will give you the money, we're not gaining no money in 3 to 4 months, right? If I get this loan, because what am I going to make? Pennies? I'd rather just hold on to the money and do a bigger deal for a longer period of time and make a bigger spread. So it's very hard to find a person, individual that would do this kind of loans, right? But even if you went down the route, this is a bad financial advice. These numbers make no sense. It's not a new mortgage unless they were ready to get the new mortgage for the home. And then the HELOC was the best way. Now, if they needed $200,000 to put on a down payment on another home, when they sell the condo, they could just pay off the line of credit that they have, pay off the mortgage, and they have the other home already that they're living in, right? So I had to do this. I had to do this diagram for you guys because I needed to break it down because there's options out there for you as a buyer or a seller. But if you're not educating yourself, or if your realtor doesn't know, you can end up in a bad situation once you sign that HUD or that contract and end up in debt that you didn't even know you ended up in. So make sure you do your research and your homework when you're looking for a exit strategy. It's called an exit strategy in an investment. If you have any questions about this video, if you have any questions, comments, drop it below, and I'll try to answer for you guys. Talk to you soon. Have a good day.